Okay, for today's class, this is going to be the last class I'm going to give to this chapter. I have quite a few videos done up now on YouTube, readily available for you to go back and watch. So I have given quite a, there's well over an hour of detail on this chapter of going through working solutions and talking about what that means, but I kind of want to tie up some loose ends today. It's going to be a short video. I intend to be a short video. What I'm going to do here is, this was something that we looked at earlier, and I only kind of briefly explained each part because there's too much detail on it to go through it quickly at the start. So it's going to be the thing we're going to finish on. This slide here, I have to try and navigate it better than that. This slide here is the balance sheet. So this is our balance sheet. We've seen it here from top to bottom. It's our fixed assets down to our capital employed. Basically, I'm going to get you to pause this video first and take this slide down in full. Everything is in the picture now, so if you want, pause the video right now, take the slide down in full, and obviously I have a bit to talk about after correcting the homework and kind of going through more information on calculations. So take that down first. I'm assuming at this stage, because you're playing through the video, that you have taken down. If you didn't, please do so after the video. Okay, so a couple of things. We have our fixed assets, current liabilities, and this section here from finance by deals with long-term liabilities and equity capital. They're the things that I wanted to highlight. What I will say is that you don't need to have a huge understanding. By the way, I'll get you to taking down this stuff as well, so take that down as well, the descriptors at the side. You can just write at the bottom if you want, current liabilities equals this, rather than drawing big complicated arrows. So at the end you can just write down fixed assets equals this, current assets equals this, current liabilities this, working capital is just this number minus this number, but you have your explanation there. Long-term liabilities, finance by is the general heading, and equity. And capital employed finally. Capital employed is something that I do want to pay more attention to, because we're asked to have capital employed for our formulas for return on investment, and it's obviously something that you need to have. Also for our debt to equity, we're asked to play around with some of these figures as well. So this is where all this is coming from when we're looking at the formulas and we're looking for how to calculate return on investment, the debt to equity figures. We're looking at the bottom here, and I'm going to show you what I mean. So again, fixed assets are your long-term assets, current assets, closing stock, debtors, and cash, things you own in the short term. Creditors, bank loan, money that you owe to somebody, owe to a bank. This is money that you owe in the short term. This is just a subtotal, and this is a total. This is a heading. These are long-term liabilities, not short-term, long-term. Debentures, I'm going to get you to add one more thing in here as well. Debenture is a form of a loan, so just write in next to it loan, because a debenture is a form of a loan. So equally there, I could say loan instead of debenture. After that, you have your equity, which is money the company raised themselves through selling shares and through retaining profits. Final figure here is called capital employed. That's just the total at the bottom. So much the business is worth, the amount of money invested in the business by all parties, debt and equity. Okay, so I'm going to bring up this here at the bottom. What this was the start of the homework question, and I'm kind of showing you what I mean in terms of calculations. So we are asked to calculate the return on investment for Blackstone Limited for 2021. This is a question I gave you. I've just rewritten it here. They give us four things: net profit, retained earnings, ordinary share capital, and long-term loan. We have to calculate this. So what's the formula? The formula for return on investment is your net profit divided by capital employed multiplied by 100 over 1 equals %. I have that there. So return on investment is ROI. This This is the formula we need to calculate. If you look through your notes, you'll see that the formula is net profit divided by capital employed multiplied by 100 over 1. Now that's lovely and good, but where's capital employed? My net profit is 114,000. What's my capital employed? Well, if you look at the balance sheet, capital employed down here is a total. And how did we arrive at that total? We added together this and this. Where did we get this? We just added these two together. So what do you do to get capital employed? You add debentures or loans, you add ordinary shares, and you add retained earnings. And I have that written here, and I'm going to get you to write that into your notes copy. Just that line there. I'll unhighlight it in a second, but just so you can mark what I'm talking about. Capital employed, which is the bottom figure here, is going to be equal to the figures that you have here that add up to make it. Debentures or loans, these are forms of loans, long-term liabilities. Shares that you issued, ordinary shares, and retained earnings that you've retained over maybe multiple years. So if that's the formula, well, that's the way you'd get to capital employed. I don't call it formula because it's just a subtotal. It's just those three added up. How do we get it for this question? Retained earnings 112,000, ordinary share capital is 280,000, long-term loan is 48,000. This one here, 200, 610, 277 add up to 1,087,000. So what do you think we're going to do here? We're just going to add them up. So that's how you get it. You just add those up. 48,000 is the loan, 280,000 is the ordinary shares, 112,000 is the retained earnings. Therefore, my capital employed for this question is 440,000. Moving down again. My formula is the return on investment is net profit divided by capital employed. So 114,000 is my net profit, 440,000 is my capital employed, multiplied by 100 over 1 equals 25.909%. Always show to two decimal places, so 25.91% is my answer. At the bottom of the question they ask us to find the return on investment for Blackstone they tell us the previous year. So this one here was to do with 2021. But in 2020 the ROI was 20%. So 2021 it's 25.91%. 2020 it was 20%. So what's happened in the last 12 months? The ROI, the return on investment for investors, has gone up from 20% to 25.91%. Comment on the ROI. So the return on investment, you can say, is the return, it's the monetary return that an investor or a shareholder would get from investing their money in a business. So if they invested €100 in 2020, they'd expect 20% return, a €20 return. But now that's gone up to 25.91%. So this is an improvement, 5.91%. It's positive. It means that there's more return for the shareholders. It means that the company has put their resources to more efficient use, or the profit has increased. That's what you're talking about there for ROI. If there's any point of that where I was talking too fast and you didn't have it taken down, or you've never heard me say this stuff before, it's in previous videos and you can pause, rewind, and take it down. Big thing I wanted to focus on here was that if they give you these multiple figures, which to be honest I think they probably will for short questions, it is common for this stuff to come up, especially in short questions, and they're easy marks. You know that the return on investment formula is net profit divided by capital employed. What in the name of God is capital employed? It's these three things here. It's your bottom of your balance sheet. It's anything that can be seen down here will add up to capital employed. So debentures are loans, ordinary share capital, retained earnings. Enough on that. So that was that part of the question. The only other thing that I want to draw attention to, I had other questions in the homework where I got you to look at discussing how to improve liquidity. We've this down here. I've these slides here made available on Google Classroom. So we can see here for liquidity, these are our formulas. The ideal ratio for current is 2:1, and quick ratio is 1:1. I've put in potentially higher, but these aren't specific numbers. You actually don't really need to know these. I would say that are slightly higher. And I'm kind of being vague when I'm going through it because I don't feel like I need to give that much information for leaving cert business compared to accounting. So I'm not going to go through it in too much information. But if the ratios are falling and if you want to improve the ratios, how do you do it? Well, you could raise more finance in the form of trying to raise more cash to pay off short-term debts. So that's one of your answers. You could also sell off stock for cash because the stock you're holding onto at the moment has monetary value. It has a worth, but it's doing nothing for you. It's sitting in a shelf. So if you sell it off, you make more money, you pay off your debts. If you don't sell it off, well, it's just a piece of, it's just a product sitting in a warehouse. It's not really doing anything. So obviously selling off the stock would improve your liquidity because you get more cash, especially for the asset test ratio. This one. The paying off creditors kind of goes without saying. Liquidity is how much cash you have, and you calculate your liquidity by comparing how much short-term money you have or how much short-term money you've coming into you versus the short-term debts. Your creditors are people you owe. They are your short-term debts in most cases, along with maybe a bank overdraft, or like bills that you've yet to pay. So if I pay off my short-term debts, I'll obviously improve my liquidity, situation because now I'm looking and saying, well, I don't really have any short-term debts, but I have a few short-term assets. So obviously I'm in a good place. So that's what we're talking about when we're saying paying off liquidity. I've gone through this in previous videos. Which I would encourage you, if you're not really sure of some of this, maybe to go back over. Finally, just kind of the limitations of ratio analysis are there. I don't really need to go through them in much more detail. I've talked about this formula. These are the formulas. This is easy because they tell you generally what these are. If they don't tell you what they are, these two, the top two, then you can play around with this to find it. So if they don't give me my net profit, but they give me the first four, I know that gross profit minus expenses is net profit. So the only way they can make this more difficult is if they don't give you maybe one of the figures from the trading profit and loss or two of the figures, but you can, remember the table and you're able to work it out. Capital employed, we said, was the bottom of the balance sheet. That's how you get that figure. Your current assets and your current liabilities and your closing stock will be given in your balance sheet here. This is your current assets. This is the closing stock. This is the current liabilities. So that's the current liability total, current asset total, closing stock. So if you're trying to calculate that, that's where you get the figures from. Just going to zoom out. These shouldn't be difficult to calculate because generally the figures are given in the question. Again, finally, debt to equity. So this is the other formula that might cause a bit of confusion. What is debt? And I've given this before. Debt is our long-term liabilities. It's our loans, debentures, and mortgages. And where do you find this in the question? You find it here. These are our long-term liabilities. Our debentures and our loans and our mortgages. They'll be written here under our long-term liabilities because long-term liabilities is money you owe in the long term. A major contributor to your debt. Debt is money you owe. So debentures and loans can be found here. Again, I haven't gone through this in much detail before because people generally get completely confused and they have no idea what the whole thing means. So it can be easier at the end. So if you're still unsure, maybe this can provide a little bit more assistance. Just because I had a few people who were saying that they're not, fully understanding some of the calculations. So this could provide some aid. Our debt is our long-term loans, the money we owe, and equity is our ordinary shares and retained earnings. Retained earnings and reserves are the same thing. It's money is kept from previous years. Where do I get my equity capital? It's here again in the bottom of my balance sheet. This is the bottom of my balance sheet. This is equity capital. This is the heading. ordinary shares, retained earnings. So when they ask you to find the debt to equity ratio, your debentures and loans are your debt, and your ordinary share capitals and your retained earnings are your equity. So if they give you this in a question, they tell you to find the debt to equity, you know debt is down here and you know equity is here. If they tell you to find capital employed, or our return on investment, your net profit will be given in your trading profit and loss, and this is your capital employed. If you need to find one of the liquidity formulas, this is current assets, this is current liabilities, and if you need to find the asset test formula, this is closing stock. That is me trying to show you where everything is from again. Obviously, look, I've done this video quite quickly. It's been quite quick, but the benefit of having a pre-recorded video is that if there is something that I've said too quickly, you can pause, see on the screen what I'm talking about, and go back and play it again, and then obviously being more familiar with it the second time around. If you watch it one time through while half look at your phone, I don't expect you to pick it up. So it may take a little bit of time if you're not sure of something to go back and watch it. If you have any questions, you can ask. But as of now, we are finished this chapter. Not a common long question, very, very common short question. So we might do it again a bit in class depending on when we get back.